Hello, everyone. I'm Lizette Gabriel, and I work as a librarian in the Business and Economic Department here at the Los Angeles Public Library. Welcome to today's presentation called How to Get a Business Loan. This program is part of an ongoing series of programs intended to support Financial Literacy Month in April and is brought to you by SCORE. Today's presenter is John Doyle, and he will cover the information you need to prepare to apply for a business loan at a bank and how the banks evaluate the information. There will also be a discussion on the types of loans that are available. Please send us your questions throughout the program, and we will have a Q&A session after the presentation. I now like to pass the presentation over to John.
Well, good morning, everybody. My name is John Doyle, and I'm a volunteer at SCORE. SCORE is a resource provider to the SBA, and we provide counseling services to small business owners. There are over 300 chapters nationwide with over 10,000 volunteers. In LA County, there are over 75 volunteers helping small businesses succeed. Our mission is to, as you can see on the screen, is to foster vibrant small businesses, communities, through mentoring and education. I happen to be a mentor, and I also do workshops for our Los Angeles chapter of SCORE. We really think it's important that every small business owner has the resources available to make them succeed. As I mentioned, we're all volunteers, and as a volunteer, our role is to help you in your business. Today, we're going to talk, oh, by the way, I'll give you a little bit of my background. I spent over 40 years as a commercial banker dealing with small and medium-sized businesses. I was never a banker to the Fortune 1000 or what in banking was known as the corporate arena. It was all dealing with local businesses and local branches. So let's talk a little bit about what we're going to do today. First of all, what do we look at? What do banks look at when we make a loan decision? So that's the 5 C's. We're going to talk about types of loans, meaning what are some of the different types of loans that banks look at. And then we're going to talk about preparing for a business loan request from a bank. So, first of all, let's talk about the 5 C's as we refer to them in the bank, in banking. Number 1, cash flow or capacity to repay, collateral, what the credit is, capital, how much net worth of the company, and character and condition. So I will go through each of these to hopefully help you kind of understand the way banks look at deciding as to whether to make a loan to a business or not. So, first of all, cash flow. When I'm talking cash flow, what I'm talking about is the money that's available to your business to use in the business, money that's in your checking account, what have you. Cash is the blood that flows through your business. You don't have cash, you're out of business. I mean, that's just the way it is. So you've got to manage your cash flow and understand what your cash flow is. So you really need to know when the cash comes in and when it goes out, meaning you sell stuff. If you're in a 7-Eleven as an example, you know that the cash comes in right away. It's either in the form of cash or in the form of credit card. If you bill people, sometimes it doesn't come in right away. It comes in 15, 30 days later. When we look at cash flow, when we're making a term loan, meaning a loan that has payments, we generally look and to say, okay, that's got to be 1.3 to 1.5 times the repayment schedule. Meaning, let's just say, for example, that you have in your company $1,500 a month in excess cash flow, meaning the cash that's coming in is $1,500 greater on average than the cash going out. If I'm going to lend you money with a payment of $1,000 a month, that $1,500 is 1.5 times that debt repayment schedule. So how the money comes in and how the money goes out, positive cash flow is really important. And that cash flow can be specific to assets. Um, for example, if you're going to purchase a piece of equipment, how much that equipment cost, how much are we going to finance it for, how long, etc. What's the repayment schedule going to look like? And it's not all bad to do financial projections on your part as to, well, I'm going to need this money to do this. What's going to happen when you do this with the money? What do you see happening in your business when you do it? So cash flow is king. It's the number one most important thing that we look at when we make a decision. So, number two, here's a cash flow cycle for you to be able to look at. Let's say I form a company called Doyle Water Heaters Inc. and I have $500 in cash in my bank account. So I buy a water heater, and if you'll notice, it's in red, which means the cash is going out. And I buy it for $500. I sell that water heater to someone for $1,000. Now, my gross profit on that transaction, gross profit, gross margin, interchangeable terms, is $500. Out of that $500, I pay operating expenses, things like my huge salary, which is well deserved, by the way. Um, Operating expenses, rent, and whatever, of $250. So my profit on that transaction is $250. Here's a question. How much cash do we have? Started with 500, went to zero, got 1,000 in. Out of that 1,000, I paid $250 in operating expenses, so I now have $750 in cash. That's the difference between measuring cash flow and measuring profitability. That is the big difference. Okay, number two, collateral. Okay, if cash flow does not work, how am I going to get my money back? I mean, it's really important that as a lender, I'm lending you money and I want you to pay me back. So let's say the number one, the cash flow doesn't work. How am I going to get it back? Well, I'm going to take a security interest in company assets. If those of you who have ever borrowed to purchase a car know that a lien is put on that car or a security interest is put on that vehicle. I will do the same thing on company assets. I will take a security interest in the company assets, equipment, accounts receivable, meaning money that people owe you, buildings, whatever. I will get the personal guarantee of the owner. And if cash flow doesn't work and I have to take possession of those assets, what am I going to do? I'm going to sell them in order to get repaid for the loan. So collateral is the second C. Credit history. So we will look at what the credit history of your business is. So if we'll go to places like Experian or Dun & Bradstreet to look and see what type of credit history you have. Do you have a good one? Is your credit history bad? If it's bad, obviously we're not going to be interested in making a loan to you. We'll also look at the personal credit history of those owners of the business that are going to be guaranteeing the debt. So let's say that you're 100% owner of a business and you have a FICO score of 720. Great. You have a FICO score of 580. Not good. Not good. We also will probably can talk to vendors, meaning let's say that you rent a piece of property for your business. Well, we could talk to your landlord and say, okay, does this business pay on time? We can ask you, okay, who are your significant vendors? Who sells you stuff that you resell? And we can talk to them about how do you pay? Are you a good pay? If you're in a business that doesn't buy from vendors, but you do have, let's say you're in the consulting business and your inventory, for lack of a better term, are people because you pay these people to come in and do the consulting work for you. That's a little bit different, but still we would look and see, okay, who do you hire and are you paying them and what have you? So vendor history is just as important as the business credit reports. Capital. Hmm. This is something that some people don't really think about when they own a business. If you have a business and you have total assets in the business and the equipment, inventory, accounts receivable of $1 million. Let's just say that. So, how much money do you owe against that $1 million in assets? Um, let's say that you have a bank loan, or that's $300,000. Let's say that you have accounts payable, meaning money you owe to people for services rendered like rent or for purchases of land of space in the building you're in, your telephone bills, whatever. And let's say that that's another 300,000. So we're now at $500,000 in total debt. In order for us to determine your net worth, we divide the total assets by your total liabilities, which was that $500,000. That's what you owe, which says you have a 1-to-1 debt to worth ratio because you take the assets of $1 million, you subtract the 500,000 that you owe, the net worth of the company is 500,000. So that 500,000 divided by what you owe, which is the 500,000, gives you a 1-to-1 debt to worth ratio, which is very strong, by the way. It's very strong. Now, in making a decision about what type of debt to worth ratio we look at, it depends on the type of loan. If we're making a secured loan by real estate, that debt to worth ratio is not as critical as the cash flow, but it's important. If you have $1 million in total assets, and you owe 900,000, you have a 9-to-1 debt to worth ratio. That's not particularly good. We would not lend you unsecured. The only way we probably do it would be on a very, very well secured basis. So debt to worth is really important. So when you look at your balance sheet every month and you see what your total assets are and you see what your total liabilities are, what you owe, look at that and see what your net worth is, and then you can do your own kind of ratio defining calculation just to see where you are. Character and conditions. Okay, we look at how long has the business been in existence? Are the owners of the business, the people that are operating, experienced in the field? Who are your competitors? Are you, if you're in 7-Eleven as an example, there's tons of competitors, but it's really geographically centric to where your location is. What are the challenges in your business line? Are there others, entities that are coming in order to to take business away from you, or are you taking business away from them? Anyway, character and conditions is something that we look at also. So let's talk about a loan request. It's really important for you to have documents ready when you go to your bank to talk to them about borrowing money. When you go to your bank, if you want to talk to a loan officer, a commercial loan officer, someone that can help you with a commercial business loan. Uh, the reason I'm specific about that is that there's multiple loan officers in banks. There's a mortgage loan officer that helps people buy homes, gets loans for homes. There's a consumer loan officer that helps consumers with things like credit card, auto loans, home equity lines of credit, loans to consumer, boat loans to consumers. You want to talk to a commercial loan or a business loan officer when you're looking for money for your business. That's really, really important. Some banks have business loan officers or commercial loan officers within their branches. Other banks have business loan officers or commercial loan officers that are in a separate department. The point is, that's who you want to talk to because those are the people that are going to help walk you through the application process and probably take that loan or submit that loan to a credit committee for approval. So you need to talk to a business loan or a commercial loan officer when you're looking for a business loan. So What do you need when you're talking to that business loan officer? Now, every bank is a little bit different, but generally speaking, these are the types of documents that you are going to need to present to that loan officer in order for your loan to be considered. Current financial statements. Let's say well, today is April 4th. No, April 6th. So today's April 6th. So you should have January, assuming you're on a calendar year, fiscal year, you should have your January 1st to March 31st income statement and balance sheet available for the banker to look at. The income statement is how much money's come in, what you've sold, and obviously what the expenses related to that, and what's the bottom line profit and cash flow. So you'll need that, the current one for this fiscal year, the one that you're in. And a balance sheet. What does your balance sheet look like? What are your total assets? What are your total liabilities? So you'll need to bring that. 2 or 3 years of IRS filed tax returns for both business and personal. 2 or 3 years. And the reason that we want 2 or 3 years is we want to be able to look at your business and say, okay, here's where we are right now with the current financial statement. Here's our profitability. Here's our positive cash flow. What happened in the last couple of years from a cash flow standpoint, from a profitability standpoint? How's the business doing? And those IRS file tax returns are important because that will show us what you reported to the IRS as your income and your expenses. And some people may come in and say, well, I'm in a cash business, and some of that cash just doesn't get on the books. Okay, it doesn't count. It does not count. I don't want to hear about, frankly, that you're hiding cash from the IRS because that's not a good sign of how the business is being operated. So I want to see 2 to 3 years of IRS file tax returns, both business and personal. I want to see a listing of your accounts receivable. So if you're in a business where you bill your customers for payment for your services rendered or for physical products sold to them, and they owe you money, I want to see a listing of those. And the reason I want to see that is to say, okay, here is an asset that you own that has value. If that accounts receivable listing is, let's say, $500,000 that you're owed, we will look and see, okay, what's the aging of that $500,000? How much is owed in the next 30 days? How much is owed in 60 days? How much is owed in 90 days? Anything over 90 days, we don't think is a valid asset. We usually would take that out of any kind of equation that we would use to calculate the value of the company. If you're buying an asset, I like to look and see, okay, what is the cost of this asset? If you're buying a piece of equipment, okay, what's it cost? And okay, we know that it's now, we've looked at that and we know that it's going to cost $100,000. How much are you putting down on that? What comes out of your existing cash as a down payment on the purchase of that asset? We generally speaking don't finance 100% of assets purchased. We generally want to see a down payment on that. We also would want to see a copy of the last 6 months of your bank statements. Wait. Why do you want to see that? Well, if you bank with me, I can go get it anyway, so it's not a big deal. But what I want to see is, I want to see the cash in and the cash out on your bank statements. So that's important for us. Again, going back to the first C, which is cash flow. So I'm going to want to look at those 6 months of bank statements to help me in my evaluation of your suitability for a loan. Your current personal financial statement. Why do I want your personal financial statement? Because you're going to guarantee the debt. So I want to see how indebted you are. If you have a bunch of cash on your balance on your personal financial statement, you have a mortgage, you have typical stuff. Okay, that's fine, but we want to see that because that's important for us to look at too. And as I mentioned a little earlier, if you're buying a piece of equipment, you might want to do a financial projection, or we may ask for it to say, okay, you're buying this piece of equipment. What's it going to do for you? Over the next year or so, how's that going to change your business revenues and business expenses? Maybe this piece of equipment is going to cut down on your expenses, or maybe it means that you can produce more at a lower cost, therefore you can sell more. But a financial projection is always welcomed by the banker. Um, so let's talk a little bit about types of loans. I've been referring to purchasing a piece of equipment and you wanting to finance it over 5 years or 7 years or whatever. Well, that's a term loan. That's called a term loan. A term loan is payable over time. So there's usually a set schedule of payments that your business has to make to repay the loan. There are really a couple of different types of term loans. There can be ones that are variable rate, meaning it's related to prime, as an example. It's prime plus 3. The interest rate will change as prime goes up. And as you have probably been reading, the Fed has been tightening up and raising interest rates. So if you have a prime related term loan, the amount of interest that you pay on the amount that you owe can go up over time. It also could be a fixed rate. The fixed rate is obviously relatively easy for you to manage because that you know what your payment's going to be. It's like a car loan. Car loans are typically fixed rate, meaning that you're paying 6% or whatever on the car loan, and your payments are $350 a month, and they don't change over the 48 months or 60 months that you have the loan. That's fixed rate. With a variable rate loan, term loan, sometimes they can be on a quarterly payment schedule, meaning you pay interest monthly, but then you make a principal reduction every quarter. As an example, you have $1 million loan over 5 years, which is meaning you have to pay back $200,000 a year in principal. So if you divide 200,000 by 4 quarters in a year, that means that you would be paying $50,000 at the end of each quarter as a reduction in principal. But you will be paying interest on that variable rate loan every single month, and the bank will be billing you on that interest. If you have that loan that's fixed rate, you probably will end up with monthly payments. You probably will not end up with quarterly payments. It probably end up being monthly payments, which is pretty typical for a term loan. Now, term loans can be for specific assets, like I talked about the piece of equipment, or another type of term loan is for working capital purposes, a longer term loan for working capital purposes. What does that mean? Well, working capital is the cash that you use in running your business. And let's say you want to grow your business, which means maybe you have an opportunity to purchase more inventory, or you just want to grow it specifically, and you say, I need a working capital loan, but I need it for 2 years because this is where I see my business going. Those would be considered term loans, and you probably would again have a monthly payment on that type of loan. The SBA offers a couple of different types of loans, a 7A and a 504. The 7A is specifically for a working capital type loan or asset purchase. The 504 is typically related to real estate. That's an SBA loan. Excuse me. And there are also things like lines of credit. If you think a line of credit, think about a credit card. That's a line of credit. In your personal life, you may have credit cards. You probably have credit cards. And you know that there's a credit limit associated with those credit cards. For example, let's say that you have a credit card, a MasterCard that has a $20,000 credit limit. Well, you use 10,000 of it, you owe 10,000 at the end of the month. You have a choice. And that choice is you make the minimum payment, which would include a little bit of principal and a lot of interest, or you pay a big chunk of it off, which would include a larger payment to principal, reducing that 10,000 to maybe 5,000, plus the interest that's owed. Once you've done that, when you originally got your bill, you showed 10,000 in owing, and you had a $20,000 line of credit, so you have $10,000 available on that credit card. Once you've repaid 5,000 of that, guess what? Your credit availability goes to 15,000 because you now only owe 5,000 in principal on the loan. That's kind of the way a line of credit works, whether it's secured or unsecured. Excuse me. Generally speaking, if you have a secured line of credit, secured by things like accounts receivable, accounts receivable are what people owe you. So, excuse me, let me go back here. I'm sorry. Um, like accounts receivable. Let's say, for example, that you're in a business and you sell product or services to others and you bill for them. That, again, is accounts receivable. If I'm a bank and I'm going to say, okay, you want a line of credit, well, I'm going to secure that line of credit with those accounts receivable, what people owe you. But as they say on the ShamWow commercials, but wait, there's more. I'm going to take a look at those accounts receivable, what people owe you, and I'm going to segment them into those that are over 90 days, which I will not include in any calculation as to how much I'm going to lend you. And I'm also going to put some limits on what we call concentrations. Let's say that you have $100,000 in accounts receivable, and you have one customer that owes you $40,000 of that. I am, as a banker, going to say that's too high of a concentration to one specific customer. So I may say, okay, well, the maximum concentration of any particular customer would be 25% of the amount of line of credit. So you have $100,000 in accounts receivable. I'm not lending you $100,000 against that. I am only going to lend you $75,000 against that. And of that $75,000 that I'm lending to you, no one customer in those amounts of money that I can use for the calculation can be 25% of your accounts receivable, more than 25% of your accounts receivable. It's called concentration. The other thing is, again, as I mentioned earlier, if there's anything over 90 days, let's go back to my $100,000 example. Let's say that you have $100,000 in accounts receivable. I'm going to lend you up to $75,000 against that, but then I take the exclusions out of the $100,000. So let's say of that $100,000, $20,000 is over 90 days. Oh, okay. That means you only have an asset base or the amount of money that I can use to calculate the 75% that I'm going to lend you against those assets. So we've got to take the 20,000 off the 100,000, which leaves you with $80,000 in eligible accounts receivable that I will use for my calculation to lend you the money. So if I'm lending you 75% against that $80,000, the maximum amount that you can owe then is $60,000, which is 75% of that $80,000. So secured and unsecured, if it's an unsecured line of credit, obviously that does not, the value of your accounts receivable doesn't factor into it because it's unsecured. And like credit cards are typically unsecured. But in the secured line of credit, we really want to look at the value of the underlying asset that is securing the loan. If we go back to collateral, which was number 2 in our 5 C's, if we go back to collateral, we can see that In the case of a secured line of credit, what is the underlying value of the collateral? What percentage am I going to lend against it? Let's go back up to the term loan again. As I mentioned, you're buying a piece of equipment. How much down payment are you putting on it? You're going to buy your building. What's the down payment? We're going to lend you 60 or 70% against the value of the building. So you're buying a building for $1 million. I'm going to lend you 70% against that $1 million. So you're going to have $300,000 to put down on the purchase of the building. So all of these different types of things go into the calculation of what we do in terms of evaluating a loan and understanding that the type of loan, the credit criteria for types of loans are relatively specific, meaning banks have policies that they go through and say, I think I want to give you, I'm only going to lend you 60% against this piece of property. Or you come to us to borrow against a piece of property, and we have an environmental report required, and they found that there's conditions in the soil that are going to require remediation. We're going to say to you, we're not going to lend you money until the remediation is done. Or if you're purchasing that to move your business, you may want to think, maybe I don't want to do this. Maybe I just don't want to do this. Oh, and by the way, for the term loan and for the lines of credit, you're going to personally guarantee it because it's important for us to have a feeling that you are personally connected with the transaction. So these are basically the various types of loans that are available. If you think about what is the use of the money that you need, what's it for, that's when you want to think about what type of loan do I need. I want to go back to the credit cards for a second. We know that in some cases, small business owners use their personal credit card to help them finance their business. We don't necessarily recommend it, or they use a business credit card to help them finance their business. Okay, if you're doing that, there is one thing that I really think is important for you to take away from this if you take nothing else away. If you're using a credit card to help finance your business or just in your business, period, do not be late on a payment. If you look at your credit card agreement, if you are late on a payment, your interest rate could go from 15 to 30%. If you're paying 15% on your credit card regularly now, if you're late on a payment, it can jump to 30%, doubles the amount of interest that you have to pay on the balance outstanding. Don't be late on, don't be late on any type of credit card payment, because the penalty in terms of interest expense to you is very, very onerous. So that's something that you want to make sure that you, if nothing else, you take away from this presentation. Again, I think it's important for you to gather all the documents together that we've talked about previously. So let's go back to these documents. Gather all these ahead of time. So when you go in to see your banker, if you see your banker and you say, I've got all this stuff for you, they are going to think, oh, well, this potential borrower has got their act together, and that I'm going to, and I'm going to look at the documents, and if things look good, I'm going to really push to get this loan approved. So if you have everything available to present to your commercial loan or business loan officer, it's really, really helpful. So we talked a little bit about term loans and lines of credit. Those are basically the two types of loans that banks make. So financial projections. At our SCORE website, losangeles.score.org, we have a free tool that's available to you that is an Excel spreadsheet. And this Excel spreadsheet will allow you to project for 3 years, month by month, what your profitability and your cash flow looks like. if you think about, gee, should I really do that? You know something? You probably should be doing it every year anyway. You should probably be doing a financial projection every year because you need to have goals and objectives in your business. You need to know where it's going. So this Excel workbook is free. You go to losangeles.score.org and click on the library and get the financial projections. And you can download an Excel spreadsheet free as many times as you want. Again, at SCORE, we do mentoring. We do free mentoring of small businesses. I happen to be one of those that does that mentoring in addition to doing workshops like this. So you can go to score.org and register to get a mentoring session set up with a mentor. We have specialists within SCORE, particularly within Los Angeles. I happen to be a person that people come to when they have financial questions and they want to talk about their finances. We have marketing experts. We have experts on SEO. We have experts on management. We have human resource experts, people that can help you in your business with specific questions that you might have or that you might just want to talk about. That's what we're here for. We're volunteers and we're here to help. But I will say one thing. When you come to us, there's one thing that's really important for you to understand. For example, in financial projections, we don't do your financial projections. That's up to you. You need to do it. We'll help guide you through how to do it, but you need to do it. It's really important for you to understand what's going on in your business. As I mentioned, we do the mentoring video. I happen to do video mentoring. We used to do face-to-face, but pre-COVID, but we will be doing, hopefully getting back to doing face-to-face again soon. But video mentoring is also via Zoom is something that we do. All of our mentoring is at no charge, and there's a bunch of resources available for you at our website, losangeles.score.org. It's really available to you free, and we're volunteers, and we're all here to give back to the community. And hopefully, what you've learned today from this will be helpful to you. I'd like to open it up to see if there are any questions that you may have regarding borrowing from businesses. Lizette, anything come in? Voice.
My bad.
There you go.
I just realized I was like, wait, I'm still muted. Okay, so let's see, and then we do have a few questions. So the first question is, why do I have to provide a personal guarantee when I have an LLC or corporation?
Well, okay, very good question. You know, people form when they start their businesses or they own a business, they form an LLC and they form a corporation, an S corp or C corp or whatever, in order to insulate them personally from any liability. So why do I have to guarantee it? It's pretty straightforward. There's an old, well, I won't go into that. There's an old saying. I want you to feel obligated to pay my loan back. I want you to have a vested interest in paying the loan back. Now, when it comes to personal liability on other parts of your business, that's why you buy business liability insurance. So, okay, here's number 2 to take away from this, if nothing else. Number 1, I said, don't be late on
Payment.
a credit card payment, right? Because what happens to the interest rate? This is number 2. You will get business liability insurance. And the reason you want to have that is if there's a problem, and and today people sue at the drop of a hat, you want to have someone big between you and the problem. So you want to talk to a couple of business insurance agents, get bids from them, because they can figure out, okay, what's the potential liability in this type of business? Let's say that you're in the plumbing business, like the mythical water heater business that I talked about. Let's say you're in that business. Well, gee, I would need to have, I obviously have to have insurance for my staff, which is required anyway. I mean, that's required by law anyway. But what if my staff takes a water heater out, breaks a line, and floods a house? And it's $200,000 worth of fix up. That's why you have business liability insurance to help you repay that and get that fixed. What happens if your someone that works for you does something that the people don't like and they just want to sue you because they don't like it? Business liability insurance. So you got to get business liability insurance. That's the second item that if you take nothing else away, that's the second item that you need. So back to your personal guarantee. You
Um,
know,
just an add-on to that, John.
sure.
So you mentioned the personal liability insurance. Is there an amount that a business should be considering, or should it be covering, like a house insurance? We usually cover for any fires and building. Would the same thing apply as to a business insurance?
Well, a couple of different kinds of business insurances. The business liability insurance I'm talking about
Mhm.
is okay, what is the potential risk for you being sued for something your business did? This is not the same as insurance on your building, insurance on your
Oh,
equipment, insurance
okay.
on your cars, the workers' comp insurance that you buy, that you have to
Mhm.
buy. This is for someone that something that your business may have done, may not have done, but you're getting sued for it, so your business has the liability for it. Um, that's why you talk to two or at least two business insurance agents because they're going to say, okay, well, all right, Doyle, you're in the water heater business. What's the potential liability that you could have? What do you think is the outside? Is it $1 million? Is it 2 million? Is it 10 million? Is it 5 million? If you're General Motors, how much liability insurance do you think General Motors has? But they probably have a huge deductible too. But I mean, like you do in your car insurance, when you wreck your car and you've got to pay, you have a $500 deductible.
Yeah.
General Motors may have, a $500 million deductible, and they may have $10 billion worth of insurance. But my water heater business, I'm probably going to get at least 5 million,
Okay.
just because. Well, number one, I was a commercial banker, so I'm really conservative. But number two, it's probably not likely that your people or you personally can
Mhm.
damage something or cause something that's more than $5 million in damages.
Okay. So
That
it's
answer
always
your question?
yes. So it's always good to be cautious and get what's good for you. All right. So, okay. So the next question that I see is, where do I get loans? And if I'm a startup, oh no, wait, let me repeat that. Where do I get loans if I'm a startup with no history?
The three F's. The three F's are friends, family, and fools. Is where you get money. Now, I'm being a little facetious when I say that, but let's go back to what I said of the paperwork required. When you're going to a bank, if you're going to a bank to get money, the bank is going to want to see 2 years worth of financial statements. So if you're a startup, the likelihood of you getting financed by a bank is not very big. Now, if you're Elon Musk, well, maybe not. But no, you're Elon Musk, and you're doing a startup, you probably could get financing. But if you'll notice, he got financing not from banks at the start. He got financing from venture capitalists,
Yeah.
from startup, companies or people that do seed financing, things like that. Um, you probably, you're probably not going to get financing from a bank unless you have a huge experience in a prior business with that bank where you've been very successful and you want to go back to that bank and say, look, and I'm starting a new business. I want to get a line of credit and I'll pledge my personal assets to secure that line of credit. Oh, well, maybe they might do it. But if you're a startup, it's very, very difficult to get financing from a bank.
Okay. It's good to know. All right. And one of our last few questions is, why at least 2 years of tax returns?
Well, it's very simple. Let's say that in 2021, you made $1 million in profit after tax. In 2022, you lost $500,000 after tax. You lost money and you had negative cash flow. And you say, well, wait. But the first 3 months of this year, you have $300,000 in profit. So if I only got 1 year tax return, 2022's, you lost a $500,000. Even though you made 300,000 in the first 3 months of this year, I'm going to say, wait, you don't have any profitability or positive cash flow history. But I go back to 2021 and I can see, oh, you made $1,000,000 in 2021. We can talk about what happened in 2022. What were the issues that made you lose money in 2021? And we can walk through it. It was COVID related. It was whatever. Oh, okay. Well, maybe there's some reasonability. Maybe I want 2020's tax returns then to see if you were profitable in 2020. The point is that I want to look and see what's the viability of the business. And so if in 2020 you made $1,000,000, in 2021 you made $1,000,000, and you lost a $500,000 in 2022, but you have a good explanation for it, and you're making money year to date, okay, I got a history here that I can consider the business for a loan. You lose money in 2022, you lose money in 2021, and you're making money in the first 3 months of this year. It's going to be a lot more challenging for me to lend you money. You understand why I'm looking for,
Yeah.
have at least 2 years tax returns, because it gives us a history of how the company can perform in various scenarios. Of course, 3 years ago, 3 years and 4 months ago, COVID hit, right?
Mm-hmm. Yeah.
I'll tell you a story. This is a personal story. My wife and I were on a trip. We were on the Diamond Princess in Japan. We got off the Diamond Princess in Japan a week before COVID hit, and the Diamond Princess was segregated and held for 3 months in Tokyo, and they wouldn't let people off the ship. So we dodged the COVID bullet.
Oh my God.
Off, we had finished the cruise, but we got off a week ahead of time. It was, I look back on that, it was like one of those.
Oh yeah.
Yeah,
That was real close.
real close. Yes, I'm sorry for injecting a personal story. But it was,
Oh no. I can't imagine the liability they had to pay off. But I do have actually a sort of a personal question on this because
okay.
I've been curious throughout your presentation. So, and you mentioned documents and whatnot, and here at the library, we're always we have patrons about talking about and looking for resources about business plans. So, when is the business plan necessary for a bank loan, or is it not necessary?
If you have a business plan that you put together,
Mm-hmm.
not the one when you started your business, but
Okay.
maybe the business plan you have for the current year, it's got goals and objectives. It describes briefly what the competitive environment is. Maybe you want to add a product line. That gives the banker kind of a sense of comfort. Oh, they know where they're going. They have goals and objectives. They know where they're going. They've analyzed the market. What I'm referring to is maybe it's just your goals and objectives and some specific items that you're going to do specifically. Maybe it's 2 pages or 3 pages. It's not the 16 to 30 page one that you put together when you started. It's just more like, okay, what do I want to do this year? Or maybe it's a 2-year plan, whatever. When I looked at the bank loan and the customer came to me with a plan of what they wanted to do and where they were going, I looked at it much more favorably than someone who's come in and says, I need money, here's my stuff.
Okay.
It's okay, why do you need it? What are you going to use it for? Have you put anything down? Have you put anything down of how you expect this to impact your business? That tells me that the people are managing their business and are looking forward.
Okay, it's good to know because that way we can tell our patrons, don't just stop at the first one. Keep
Every year,
working on it. Yeah.
yeah, every single year when I was in the bank, every single year, and I had to do a business plan for my divisions over the course of the next year. I had to put in goals and objectives, metric goals and objectives. What are we going to do differently in terms of, are we introducing product? Are we going to change the mix? What are we going to do to grow our branch network? Whatever.
Mm.
But I had to do that every single year. That was a requirement of the banks I work for. But I would have done it anyway, just because I really think it's important for people to have a goal, to have an objective, because they will work harder towards getting to those goals and objectives. And that's what I felt when I ever was talking to a customer about a potential loan. Okay, what are you going to do with this? Do you have anything, an outline of what you think how this is going to help your business?
Yeah, because yeah, sometimes then you have them in front of you, and I'm pretty sure that all the, like you said, you bring the paperwork, but instead of maybe talking about their business and showing them who they are, they're just like, "Oh, here's my paperwork." It's
Yeah, I mean,
personal touch.
but and it's important because
Mhm.
people took the time to plan. Number one, but number two, I'm going to interview those people also. I mean, if this is a client who's been a longtime client of the bank that I've known, that's going to be very different than someone who's relatively new to the bank. And I'm going to want to talk with them and more about how they manage their business, what they're doing, what have you. But, if it's a longtime client, I still want to see a plan.
Mhm.
I still would like to see a plan. Maybe not mandatory, but I would like to see a plan just because I think that's one of the things we do at SCORE is that when we talk to small business owners, we say, what's your plan? Who's your competition? What's your TAM, your total available market? How are you going to attack that market? Um, what does it take for you to do that? How much money are you going to need to get to these specific objectives? So when, at SCORE, we like to ask a lot of questions.
Okay, good
You
to
know,
know. Good to
yeah,
know, because that
well,
way,
make people think.
yes, and when we're, giving references and saying, "Hey, go to the SCORE mentors," we can at least have an idea of what it is you guys sort of bring to the table when you meet with them.
Right.
So we're getting close to our time, and I don't see any more questions. So now I'm going to talk a little bit about the library and programs we have upcoming. So this is my part to end our presentation. And as I mentioned before, we do have a list of programs and subject-related books, which are available in the Financial Literacy Month website, which I believe, oh, there we go. So there it is. And of course, the programs go through April, through the end of April, ending with, I believe, also a financial planner on that last Saturday of the month. So you, again, please take advantage of these programs, both online and in person if they're available. And if you didn't get a chance to view our program from the beginning, this presentation will this presentation will be available on the library's YouTube channel as well. And thank you, John, for being with us here today. Thank you, everyone, for joining us today. And please have a great afternoon.
Thank you, Lizette.
Mhm. Thank you, John.